watch the class capture if you were not able to be here, so you can catch up to where we are today. But we had 3 different types of marketable securities. What are they? What were the 3 types? You can all say it out loud. Yeah. Okay, so not that hard. The hard part is, why are they classified as held to maturity? What does that mean? Again, everything about this class is financial statement impact. So what's the impact on a held to maturity on the financial statements? It is on the books at historical cost. So it follows the historical cost concept. We don't do anything. It just stays on the books at cost. Nothing is reported at fair market value. So it has no income statement effect when it's on the books. Trading securities are different. They're bought with the intent to make a profit in the short run. So they would be classified as trading and put on the books at their fair market value, which is the stock price at 12/31, the end of the year when they're making financials. So the balance sheet is going to show fair market value, which is going to be different than its cost. So we have an adjustment needed. And since we hadn't actually sold the securities, they're still there, we have what we call an unrealized gain or loss, which is showing up on the income statement. Why is it on the income statement? Because it's trading. Its intent is to make a gain or loss in the short term. So it is actually showing up on the income statement as an unrealized gain or loss. Available for sale are just the securities that we invest in, and we're holding on to them. There's no intent to make a profit in the short term. We're just trying to maximize shareholder wealth. Trading and available for sale are both valued at fair market value. So the balance sheet for available for sale will increase or decrease based on what the stock market value is the day you prepare financials. So the balance sheet needs an adjustment. We know that if there's an adjustment, it's always affecting the balance sheet and the income statement. In this situation, since it's an available for sale and there's no intent to make a profit in the short term, we don't actually put the unrealized gain or loss on the income statement. We bury it in owner's equity. And it's considered part of a separate account called comprehensive income, which you can think of as part of retained earnings. So like we start with beginning balance and retained earnings, we add net income. So in net income would be trading's unrealized gain or losses, not available for sale. Then we subtract dividends. Now we can think about another component of retained earnings or owner's equity, unrealized gain or loss due to available for sale securities. So that is a summary sheet that can be very helpful for you when you're looking at this information. But it's important to make sure you do understand those 3 different types of securities. Questions on those? I'm going to show you an actual balance sheet. I actually have Apple's financial statement. Everybody knows the company Apple, right? Everybody okay with this? On Apple's, and this is just not going to work well. On Apple's balance sheet, I'm just going to pull up the very first part of it. Just give it a second. It's still warming up a little bit here. I've highlighted a couple of things, which I hope you can see. But we have Apple's most recent financial statement, And on its most recent financial statement, you can see that under assets, it has short-term marketable securities and long-term. We talked about categorizing things as short-term or long-term on Tuesday. What kind of securities could you conclude that they have here if they have things listed as short-term and long-term? What might they be? Are they stocks? So you think it might be stocks there? So stocks might be a short term? Is that the only things that we can have as marketable securities? We talked about other ones last class too. Federal or state? What? What's that? Can we buy debt of the government and debt of the states? Bonds? Treasury bonds? Anybody remember that from Tuesday? Yes? So it could be debt. So we have long-term and short-term. So short-term means that we expect to realize a profit in this one. We expect that we'll probably sell them in the short term, or they'll become due, meaning the company we have debt with is going to be paying us in a year or less. And then we also might have some investments that maybe won't be paying us for more than a year. So it could be other debt or securities that might be long-term. So the question becomes, how do we know for sure what this information might be? Well, we can actually go into the financial statements and look at some of that information. And some of the things that we find, you won't be able to see probably all of this very well, but in note 2 of the financial statements for Apple, you can see what they have for securities. They do have Treasury securities, debt, other agency debt, non-U.S. government securities, time deposits, meaning these are really bank deposits that give you interest, CDs, certificates of deposit. They have commercial paper, corporate securities, stocks, munis, which is state securities or debt, and then mortgage or asset-backed securities. So they have all these different types of securities, and they have to show which ones are short-term or long-term, meaning we'll be getting receipt of those in the short term. So short-term is important because that can help us to pay our other current liabilities. So it's important to know that. We can also get more information on this by actually looking at our retained earnings area. And we have, for our information, we can see that part of our retained earnings is our net income, and then we have our dividends, and they have repurchasing common stock that we'll actually talk about in Chapter 11, and then stock for our shareholders. And we can also see that in this other comprehensive income or loss, which is really just part of stockholders' equity, it is 941, and this actually directly relates to the unrealized gains or losses on these securities. So, since this amount is listed in owner's equity and not in the income statement, what types of securities do you think they're classified as? If we can see the gain or loss, the unrealized comprehensive, it says unreal. This is actually unrealized gains or losses on marketable securities. If it's buried in owner's equity, what type of security is it? What would it be? Anybody? Available for sale. So they have available for sale, and I can also conclude that they have held to maturity because it even says to me, and remember, held to maturity, is there any unrealized gain or loss on an income statement or in owner's equity? No, it's just valued at its cost. And I can see that there are those because I see many categories of these, munis, U.S. Treasuries. So this is just an example of what you're learning in class is actually reported and how it's reported. So I can tell there's no trading securities because nothing is actually coming through net income. It's just being reported separately in the owner's equity. Likewise, if you look at a balance sheet, this is much more simplified than you'd see in Apple or any other publicly traded company here. So let's look at this. We'll take this in pieces. We have an income statement. And I'd like you to tell me, based on this income statement, what type of securities we have. So the first column, we have income statement, held to maturity. Is there any unrealized gain or loss in held to maturity? It says nothing here, right? What does it say? What does that mean? What does it mean if it's realized? That was way back in chapter 2, realize versus recognize. What does that mean? We actually sold it. So we know that there was some gain, there was an actual realized gain on the sale of some of my held to maturities. That's what it's saying. There's no unrealized, and that makes sense because held to maturity is not fair market valued. The next category, trading. What's happening in trading? And is it right? What's happening in trading? We still have realized gains, which we know are directly related to held to maturity because it's the same price, same amount. So we have realized gains. And what else do we have for trading on the income statement? An unrealized gain. How come there's an unrealized gain on the income statement for trading? Why? Cash has not been exchanged yet. We didn't sell them. But trading securities, where do you have to show the unrealized gain or loss? Where does the unrealized gain or loss have to show up for a trading security? Where does it have to show up? Where do investors need to see that? The income statement, if it shows me this, when you look at someone's income statement, it's not going to tell you that they actually have trading available for sale. It's just going to say unrealized gain or loss. If you see unrealized gain on an income statement, what type of security do you know they have? Trading. It's not going to say trading security. It's just going to say unrealized gain or unrealized loss. If you see that on an income statement, you can conclude they have trading. Likewise, available for sale. Same deal. Realized gains always show up on the income statement because they have been realized. The stock was sold. How come there's no unrealized gain or loss on available for sale? We know available for sale must be recorded at fair market value. Why is there no unrealized gain or loss on the income statement for available for sale? Where is it? Is it somewhere else? Where? Owner's equity. So because I don't see an unrealized gain or loss on the income statement, I would look at owner's equity. I would look at it and say, well, do they have any other marketable securities? Do they have anything else? And if I look down at my balance sheet, I would see that there is unrealized gain or loss on investment securities. It's another component of stockholders' equity. For the most part, you will be recording it within retained earnings to make our life a little easier. So if I see that here, I know, oh, that's available for sale. Those aren't held with the intent to make a short-term profit. So you have to understand why they're classified the way they are. It's to give stockholders an understanding of the riskiness of that company. How risky are you if you just have held to maturity? Low, medium, high. Low. Trading. High. Available? Medium. Do you understand what that's getting at? It really does help investors to understand what the riskiness of a company is. You can also see held to maturity, it is at cost. So notice the held to maturity, a value never changed. Whereas the investments that were trading and available for sale, They cost $7,000, but at the end of the year, their market value, both of them had $7,700. That adjustment was $700. It increased the balance sheet, and for trading, it increased the income statement. For available, it increased the balance sheet, and it increased owner's equity. It was separately stated, like dividends, right? Think of that as dividends. So those are just different things to know. If I don't tell you if it's available for sale, if I don't tell you it's trading, if I don't tell you it's held to maturity, and I give you something like this, you need to be able to say to me, okay, well, if I don't give you the headings, you know, that's held to maturity. Well, that's got to be trading because I don't see any separate component here for unrealized gains or losses. And this has to be available for sale because I see it's marked to market. It had a cost of $7,000. Now it has a value of $7,700, and the difference is separately stated in stockholders' equity. So I know that's trading. I know that's available for sale. Questions? So let's try a couple of these to make sure that we understand the basics. Two eye clickers on this. And I will show you the T accounts when we need to, so you can see that too. The difference between realized gains or losses from unrealized is that if we have realized a gain or loss, the security was sold and taken off the balance sheet, and the gain or loss flowed to the income statement. Both of these must happen together. A is true, B is false. So we just talked about that. Everybody all set? Give you about 10 seconds. Good? All right. True indeed. So, if you're having trouble between realized and unrealized, that probably means you were struggling through Chapter 2, and so this is another way to get yourself up to speed on making sure that you understand these concepts. Realized means cash was exchanged in some way. Unrealized means there was no cash exchanged. So if we actually realize a gain or loss, it means that we sold something that was on the balance sheet. And now we have a gain or loss hitting the income statement. So both have to be affected. The balance sheet must go down, and the income statement must be increased or decreased depending on a gain or loss. Nope, every security is on the balance sheet. So whether it's trading, available for sale, or held to maturity, you changed cash to get a security. So that is credit to cash, debit to your security. So if you sold it, you're going to credit that security, debit cash. And the difference is going to be a gain or loss. So you have to be affecting the balance sheet and the income statement. Does that make sense? Other questions on that? Some of that just might be having not been here on Tuesday too. Try this one. A security that we are holding with the intent to make a profit, so you have to know what type of security this is, was bought for $2,000 And at 12/31, we are doing our financial statements, and the security is worth, based on stock market, $2,500. What happens to the income statement at 12/31? So I'll show you these as entries as well. About 10 seconds. Five. Everybody's good? B is correct. Okay. So the first thing we need to know is, what type of security is this? What is it? It's trading. And how do you know it's trading? How do you know it's trading? The intent is to make a profit. So if that's your intent, it is a trading security. It's not just an investment to hold on to maximize shareholders' wealth. It is to make a profit. So which one can you throw out right away? A. There's something that happens here. What's the next most likely one that you can throw out? B. And how do you, no, D. Not B. D. Why do you know you can throw D out? Because it doesn't say anywhere that we sold it, right? Where does it say that we sold it? We didn't sell it. It's just saying that at 12/31, our financial statements have a security with a fair market value, stock market is fair market value, of $2,500. So what happens? Let's look at that. We bought a security. The security was $2,000. All I did was take cash. I had extra cash, excess cash, MS, marketable security. I used my excess cash to purchase an investment. And I label it trading so that I know at the end of the year, where must a gain or loss go? Where does a gain or loss go if it's trading at the end of the year? What's IS? Income statement. So at the end of the year, we know the value of this was $2,500. What happens? What's the adjustment that needs to be made here to fix the assets and owner's equity?
Make it under owner's equity, make a new
account. Yep.
For unrealized gain of $500.
So we need to somehow make this from $2,000 to $2,500. I'm going to increase this account. It's an adjustment. How do I know this is an adjustment? What did it tell me to make me understand it was an adjustment?
Because it was at the end of the year.
End of the year, 12/31. So again, it's one of those situations where at the end of the year, when you're making financials, you look at all your statements and you say, look, I have a marketable security that's trading, which means I need to market that to market. I need to actually take the fair market value. Well, if the fair market value is $2,500, I need to fix this account. I need to adjust it. It needs to increase by $500, and I'm going to have an unrealized gain. And why do I say unrealized? I haven't gotten any cash for it of $500. Do my debits and credits equal each other? This is part of the income statement. It is on the income statement, so you must make sure that you remember that. It's part of the income statement. It's not just a separate component of stockholders' equity like available for sale would be. Available for sale is similar to a dividend in reporting, right? Dividends don't show up on the income statement. They just show up as a separate component of retained earnings. So available for sale will have the same thing, whereas trading, it's on the income statement. Questions on that? Anything? Yes?
Well, if it's like a realized gain, how would you report that?
Realized gain would be exactly the same, except that you wouldn't actually have this situation. If you sold it for $2,500, you would have cash going up for $2,500. This would go down for $2,000. So this would be zero now. The difference between the cash you got for $2,500 and the value, the cost. Remember, sales price minus cost always gives you what? Gain or loss. So this is the same thing you're going to do if it was fixed assets, right? Except cost would be your net book value, right? Fixed assets, because you need to subtract the accumulated. Same thing here. We got $2,500. We take it off the books because it's sold. It's no longer here. What's the difference? A gain. So it wouldn't be unrealized. It would be a realized gain on the income. Realized gains are always on the income statement, no matter what the security is. Does that help? Other questions? Anything? No? Okay. Is there anything else I can answer for you, or any other questions you have on marketable securities that we've covered today? Anything you would like to know, see, understand better? I don't believe you, but we'll move on. Yeah?
I thought we said before that the income statement wasn't affected since it's not realized.
Trading security, you're always recognizing on the income statement, trading. Available for sale, where is that recognized? Where would this be? Where would an unrealized gain or loss be if it was available for sale? Where would it be? It's just a separate component in stockholders' equity like a dividend. It would not be on the income statement. So just like I showed you with the Apple example, we were looking at owner's equity, and it was stated right next to retained earnings, not on the income statement. Others? Yes? It's not temporary because it's all marketable security is a permanent account. Available for sale just means that you have extra cash. You're trying to maximize your shareholders' wealth. The reason why we're not going to classify it as trading is because trading means you're literally buying it to sell it within usually 30 days, 40 days. Like a company's going public. You're buying it, you're holding it till it spikes, and you sell it off and you make a profit quick. That's pretty risky to do that with extra cash, because you could lose it, right? You could lose it in anything, but to maximize shareholders' wealth, if we just buy stock in Apple or other Fortune 500 index funds, if you will, what we're trying to do is make more money than just putting it into a savings account. So when you buy a security that's something that you're holding, You're not selling it just because one day it might dip a little bit or one day it might go up a little. You're holding it to try to make a long-term profit because that's what those stocks do over the long run. So if that's your intent, it just stays on the books as it's a marketable security available for sale. The reason we have to mark it to fair market value is because it's a security that all of us would be able to say what the value is on a day. If we all go to the stock market right now and look at Apple's stock price, we're all going to see the same price. The minute if we all bought it at the same time, we all pay the same price, but then it would either dramatically go up or go down depending on what's happening in the market. So because we can do that, we can deviate from historical cost because it's not an appraisal. So that's the only reason why we're classifying them differently. And again, where the unrealized gain or loss shows up is to help you understand, as a shareholder, as an investor, how risky is that company? If you have unrealized gains on the income statement, you know they have trading. So they're playing with their money, and that's risky. Versus available for sale, they have extra cash. They invested it to grow. Does that make sense? Awesome. I can tell you that Microsoft had a lot of excess cash on their balance sheet that they had not invested, and they had no plans for future growth with it, and the shareholders demanded that a dividend be paid out because they weren't planning to use that for anything, and they weren't investing it. So the shareholders wanted that money so that they could make more money for themselves. And Microsoft actually ended up paying out for the first time ever a few years ago, $34 million to their shareholders in excess cash. So you have to maximize shareholders' wealth. So if the company's not going to do it, your shareholders are going to force you to do that sometimes. The next topic that we are going to talk about is really understanding a basic concept called time value of money, but it can be very hard because we all understand what something is worth today. We might not really be understanding what that value is in the future because it's hard to do that. But time value of money is really just based on one simple truth, that $1 today is worth more now than it would be 10 years from now or even a year from now. We talked about the candy bar example before. You guys you paid $1, $1.25, maybe $2 for a candy bar, and I paid 25 cents way back when. So I could buy a lot more 30 years ago than I can now with 25 cents. So $1 today is worth more now than it will be in the future. So when a company is trying to make evaluations on business decisions, time value of money becomes very important because sometimes their business decision is based on dollars in the future compared to dollars now. And you really can't just compare $5 in the future to $5 today. You have to be able to bring them into the same time frame and decide which option is the better option for me. So time value of money. $1 is worth more now than in the future. Why? You can invest $1 now and actually earn more wealth. So if you invest $1, you're going to have more in the future than just $1. So we earn interest as time passes. We've pretty much only talked about interest in this course so far as simple. So we've just said interest is principal times time times the rate. And what was the rate always? So we're going to be refreshing ourselves on interest. Rate is always divided by what? What's the denominator for interest? Always. 12. And interest rate is always annual. Interest is the return you receive for investing your money. For the most part, we've just been looking at it in terms of I'm just going to be receiving interest 1 year, 1 year, 1 year. Just very simple. Compound interest is how the world really works. When you hear people talking about their retirement, and really, the best advice, again, that you'll ever get from me is the minute you have the ability to start saving for retirement, you do so because The money you put in now is going to be worth so much more than if you started putting it away in 10 years or in 15 years. Because of this concept of compound interest. Compound interest is really earning interest on top of interest. So, anybody have a savings account? That savings account earns interest not just on the principal that you originally put in, it earns interest on the principal plus the interest that's being reinvested all the time. That's compounding your interest. It's compounding your wealth over time. And if you have a pretty good interest rate and you leave that money in there for years and years and years, you're going to have a lot more interest than if you just earned it on the principal alone. So, compound interest. So here's our simple interest. Principal times rate times time. That's it. Time, again, number of days until maturity divided by 365. It's always a year. So that's our simple interest calculation. Principal times rate times time. It's the easiest way for us to teach you basic interest information. We don't want to get into compound interest right away because that takes a little bit more of a calculation. And one thing I don't like, that I think some of you probably don't either, is math. I don't want complex math. That is just too much. I don't want that. So I like to deal with simple. And if I have to deal with compound, I'm going to use a financial calculator or I'm going to use tables. And that's what you're going to do in this class. You're going to use tables. If you want to use a calculator to do it, you totally can. Let's just give an example of simple and compare that to compound so you can see what I'm talking about. What's the difference between simple interest and compound, which is what really happens in the world. So our basic example here is, let's say principal is $10,000. Our interest rate is 10%, which is extremely high. Interest rates are below 1%. Time, let's say it's 3 years. So I'm going to put $10,000 into a savings account that's going to earn 10% for 3 years. If I'm doing simple interest, how much interest will I earn over 3 years in simple interest? Right? 3? 10,000 at 10% times 3 years. All I'm doing in simple is taking the principal and earning interest on principal alone, correct? Compound, you not only earn interest on the principal, you earn interest on the principal plus the interest you earned in the prior year. So under compound, I should have more interest in 3 years than I would under just simple. So let's look at an example of compound to compare the two. Same exact facts. Beginning principal, $10,000. I earned interest in year 1 of $1,000. So what's my ending balance in that savings account at the end of year 1? $11,000. Next year's interest will be greater than $1,000 because my balance is more than $10,000 now. So my balance in year 2 is $11,000. $11,000. Again, at 10%, I just earned an extra $100. So now the ending balance is $12,100. So I've earned an extra $100 just by compounding. Year 3, my balance is $12,100, not the $10,000. Again, multiplied by 10%. Now I've earned an additional $200 on top of that original $1,000. So if I'm comparing simple interest, $3,000, to compound, I have an additional $310 over 3 years. Does that make sense? Take those amounts and try to extrapolate that over 30 years. Do you really want to sit here and do a table like this 30 times? No. No, my teacher used to make us do that. Okay? We'd have to do it 30 times because we had to understand and see how much compounding really, how much work it was. We just use tables now, okay? We all understand basic math things, but we can use tables or financial calculators that actually help us, or you can use your exponents if you want to. Do you remember those? You can use those too with a regular calculator. But Compound interest is how it works today. This is just compounding at the end of every year. Compounding pretty much works every day. The reality is it works every day. So when people give you examples of, hey, if I put $10,000 into a savings account right now, earning 10% for 30, let's just say it's, I can only really go up to 20 on this, but 10% for 20 years, I would have, and I'll show you this in a second, I would have $67,000 after 20 years. Okay? It's a hell of a lot more than 10,000 at 10% times 20, right? So compound interest, it has a dramatic effect on what you will have when you retire. So the earlier you start, the more you will have, the earlier you can retire, and God forbid Social Security is not around, which is threatened, you don't have to rely on anybody else, okay? So please, start a 401k. Get involved in, if you get a job that has a 401k or 403b, you start investing because your employer has to match money. So your employer will automatically match to your retirement. You putting money in, you will learn to live without 10% of your income because when you retire, you'll be that much happier. So please trust me. I already had a student who's a senior who started putting money into an IRA. She's, she really took that to heed. So she's going to be well set when she gets out. So compound interest. Let's look at the tables. In your book on page 778 and 779, you are going to use some tables. So when you go to your ebook, you can just plug in, search 778, 779. They are the time value of money tables. OWL 10-1 has these tables, but they're truncated because the tables they're rounded. In 10-1, I make the tables even smaller so that they all fit on one page so you can do your OWL homework. So that way you're not typing out like all these long numbers to do your homework. So they're truncated. That's why I say make sure you use OWL 10-1 instead of the tables in the textbook, because you'll be finding wrong answers due to rounding. But time value of money, Appendix F. So Appendix F is very short. There's a few problems you're going to do. There's 3 problems on Connect that you will do for this, and that's it. And I think there's 3 problems for marketable securities you do, not that difficult. Remember, next week in lab, who's the only lab running? Monday labs are running on Tuesday, and you have some really good worksheets that I'm going to be posting up online as well so others can do it. But future value of a single dollar. So we have to say to ourselves, if I'm using a future value table, why would I be doing that? Because I'm trying to find something that's in dollars today, and I want to add interest to find out what it would be in the future. So a future value table will add interest and helps us understand what's the dollar today going to be worth in 10 years from now. Present value tables can take future amounts. So we know what we're going to have. We're going to have $10 in 10 years. But what would that be worth in today's dollars? Because that helps us to make a decision on whether or not I'm going to do that option. So you can take future dollars and bring them back to today. That's called present valuing. It's also called, write this down, discounting. And we'll be talking about that when we get into chapter 10. So present valuing is also known as discounting, which means you're taking interest away. So we're taking interest away and bringing it back to today's dollars, today's values. So that's just lump sum. Lump sum means it's a one-time amount. So future value, I have $1 today. How much is that worth in 10 years? That's $1 in 10 years. Present value of a lump sum or $1 is $1 in 10 years. What is that worth today, that same dollar? The next 2 tables are the same thing. It's future or it's present. But you're doing more than one payment. So it's going to be, how much would $1 be every year for 5 years? What's the future value of $1 every year for 5 years? So if I deposit $1 every year for 5 years at 10% interest, what's the future amount of that? What is that worth? That's obviously going to be worth more than $1 because you've input 5 over 5 years. Present value is you have these future cash flow streams. So you hit the mega bucks. You're going to get $20,000 for the next 5 years. You want to know, well, what is that worth today? And there's reasons why you want to know what that's worth today. So you're going to see the words annuity. What can you conclude the word annuity means? Annual amounts, the same amount annually, annuity, annually. Some people will buy annuities so that at retirement they'll get the same amount of money every year for a certain amount of years. So a lump sum means one-time payment. Annuity means multiple. And I'm going to show you lots of examples. But these are the tables. In your book, this is what the tables look like. I'm just going to show you snippets of it because I can't fit the whole thing up here. But we have Table 1 on page 778 is future value of $1. Notice that if I put $1 in for 1 year at 4%, how much will I have? $1.04. Now what if I kept that same dollar in at 4% for 20 years? How much would I have? So when you're looking at the tables, you have to ask yourself, am I looking at the right table? If I'm trying to find a future amount, it has to be worth more than it is now, right? So in this situation, I'm adding. It's more than 1. These factors are greater than 1 because I'm adding interest to that one amount I have now and trying to find out what it's worth in the future. If I'm discounting or present valuing, what do I expect the tables to look like compared to here, the future? Should they be greater than 1? Less than 1. So if I am looking for, I have $1. I'm going to get $1 in 1 year, and someone says to me, I'll give you 98 cents now or $1 in 1 year. Which one sounds better to you? Just out of general, which one sounds better? No, $1 sounds better than 98, doesn't it? Come on. I'll give you $100,000 in a year or $98,000 now. Which one do you think you want? No, you want the 100. You think you want the 100,000, right? The first instinct for people, and let me tell you, I've had 3 clients in the past 4 years hit the mega box for $1 million. 2 of them did not call to find out what their option is. 1 did, and I'll explain that to you guys. But you need to understand basic time value of money to make the right decision for you. So if they say, we'll give you 98 cents now or $1 in the future, you're going to look at this and say, okay, well, what is the dollar worth today? It's worth 96 cents, right? So isn't the option to get 98 better than waiting for a year? I'm actually getting more today than I would be at today's rate. And I can take that 98% now and put it in and earn 98 times 1.04, right? I can actually earn interest on that. If it's 4% interest, I'd earn an additional 4% interest on that, which would push me over $1. So you have to be looking at that. If someone says, I'll give you 90 cents today or $1, which one would you pick? I'll give you 90 cents or $1. 90 cents right now or $1. What's that dollar worth today at 4% interest? It's worth 96, but they only want to give me 90, so which one am I going to take? I'll wait for the $1. So it's really important to understand time value of money. So in these examples, discounting is less than 1 because you're taking interest away. Future value, you're adding interest to it. When you get to the annuity, if you have an annuity, so if we have the same situation as the first one where I said you are going to be, it's $1 at 4% for 20 years. But in this situation, I add $1 every year. So the annuity, I add $1 every year for 20 years. Same interest rate, 4%. How much is that worth now? 29 versus 2. So do you see the difference between just putting $1 in for 4% for 20 years versus actually $1 every year at 4%? That's what happens with your retirement when you start saving. Every time you put money in, the earlier you put it in, the more it's going to earn interest, because it's going to earn interest on principal plus interest, principal plus interest. So annuity, these factors are going to be much higher than the lump sum because you're putting in extra money, the same amount every single year. Likewise, you can also look at your present value table and say, well, if I'm making 20 payments of $1 in the future, if I'm making 20 payments of $1, what are they worth today? 96 cents. Same exact thing, because this is happening on day one. So present value of $1. But you'll notice as it goes up, your factors also go higher because it's an annuity. So let's practice with these. First thing, let's pretend that you won the lottery, because that's a fun thing to do. Let's just pretend we won the lottery. This is similar to a situation that I've had. Option A, you can have $1 million paid out to you at $50,000 a year for 20 years. Or option B, you can have $600,000 today. Which option will you choose? Use 6% as your interest or discount rate. So based on what you understand right now, just this is not a right or wrong answer. I'm just curious. Which option do you think you want? About 10 seconds, take a guess. Just tell me A or B, which one looks best to you. As long as you answer, you get credit. Everybody, all right, A or B? You're good? All right, so option A looked best to our group here, not by a ton, but by enough. What is it that we would have to do to make this decision? Because this is something that is real life. You're usually given this option of lump sum today or payments in the future for a certain amount. How do you know which one to decide? Do you just really look at it and say, well, I'll just take the one that looks bigger? Time value of money does come into play on this. What does it mean when it says that you have a 6% interest or discount rate? What does that mean? Are these both in today's dollars? We want to make sure, are they in the same time frame, these payments? Is it the same time frame? $600,000 today, we understand what that's worth, right? What can we buy with $600,000 today versus $50,000 for what? 20 years. So aren't those future amounts? So we're comparing future amounts to a present amount. How can you really do that? You can't. You need to put them into the same time frame. So what could I do? I can easily see what $60,000 is worth today. Could I take those future 20 payments of $50,000 and put them into today's dollars? Could I figure that out? What would I do? What table would I use? what table would I use? So if I take the future value, what is the future value going to give me? I have 600,000 today. What will future do? That's going to give me a future amount, correct? I want to compare these options in today's dollars to know which one is worth more. So I'm going to discount, right? I'm going to take the 50,000 for the next 20 years because we know the 50,000, when are those happening? They're happening in the future, right? I want to know, what is that worth today? Compare that to each other. So I can look at my present value, because I need to present value this. I need to find out what is it worth today to compare to the 600,000. But the question is it an annuity or is it just a dollar? Is it annuity or just a one-time? Is it 50,000 an annuity or just a one-time payment? It's an annuity. It's happening for 20 years. I'm getting 20 payments of 50,000 in the future. What is that worth today? At a 6% discount rate for 20 periods, I think I said 20, right? Let's just double check. 20 years. So this would be my actual rate of interest. This would be what I would use to discount the 50,000 by. I'm taking interest off. 11.469921. Everybody okay on why I'm using that table, present value of annuity? If I look at that, I would say the present value of the 50,000 for 20 years at 6% is this factor from the table I picked. Now, I can do this out on my little chart if I would like to do that, but that's very hard. So 20 years, 6%, multiplied by 50,000, what do I get? I want to know, what is that worth today? So that is worth $573,500. So at the current discount rate, which technically is the market rate, that's worth $573. So which option do you want based on nothing else but the market rate of interest? Which one do you think you want? You want the one that's going to give you more, or the 600,000. What things am I totally ignoring in this calculation? Can you see anything that I'm ignoring in this calculation? Because I'm saying a 6% rate for 20 years, which I'm saying is the market rate. So I'm saying I could deposit $573,500 today at 6% for 20 years and have $1 million, right? Because that's what's going to be. 50,000 for 20 years is $1 million. That really translates to $573,500 being deposited today at 6% for 20 years. So I'm comparing. I can only make a decision if I compare this. But what am I just ignoring here in this calculation? Do interest rates stay the same every year, every day? No. So in this class, we're keeping this as simple as possible. I'm ignoring interest rate fluctuations because if they were going to fluctuate, I would need a very complex Excel spreadsheet, which I will not make you do, to find net present values and actually have it so that it would change interest rates based on forecasts. We're not doing that. So we're keeping interest the same over time. Okay, that's the first thing that we're doing. Can anyone think of another thing that we're ignoring, which has an effect? Begins with an I. We talked about it with LIFO and FIFO. Inflation. We're expecting inflation to stay the same. We're ignoring that. You have to do that to make this simplified for us. I only really want you to understand the value of time, value of money, why it's important to know it, to make comparisons in business. Anything else that I'm ignoring? One of my clients who hit the mass lottery had other issues. And one of them was taxes. So if I'm going to take a lump sum payment of $600,000, I'm going to pay taxes on it that year. And that's going to put me into a very high tax bracket for that year, the highest that there is. And I have to make sure that what decision I make, I consider time value of money, I consider interest rate fluctuation, I would be considering the inflation rate, and I would be considering my client's taxes. So I had one client who won $1 million. He opted to take $476,000. That's what he got after taxes and inflation. We decided to do that because he really has an issue with gambling, which you probably couldn't tell by playing lotteries and things like that. So he probably loses on average like he lost like $70,000 that year because he was playing it. So we actually had losses that we could take against his winnings. So that helped us with his tax situation. But the other thing was, he had no other form of retirement. And if he decided to take the payout every year, he was more likely to just spend that money than he would be with what he did. He actually purchased a house. He invested in a house. He paid for that house. And here's did I tell you this kicker about the money in the barn? So he buys this house in West Hampton, Mass. Lucky, everyone's like, oh, he's so lucky, he won the lottery. I'm like, do you know how much money this guy's lost playing the lottery? Like, it's a wash, okay? He buys this house, kind of as is thing. There's a barn in it. They're cleaning out the barn. They find $98,000 in cash. This is not a joke. He paid $200,000 or something for the house. He got $98,000 in cash in the barn. So the people that owned it had passed away. I have a friend that works at Florence Savings Bank, and they vividly remember that couple taking out their money when the stock market went down in 2008. When the market crashed, they got scared. That's all they had. They took it out and they hid it in their barn. Okay, $98,000 in cash. Yeah. They pass away. The kids sell off the house. They want nothing. They didn't go through anything. Okay, and then they came back trying to get that money, and unfortunately, hey, buyers keepers. So it was my client's money. He has subsequently put money away for retirement, so he can't spend it on gambling, but I'm sure he'll probably spend it when he retires, but he's getting better. Another client did opt to take the money as they went because they already had money. You've got to take this into consideration because it does affect how much you get. We all want to have the most, right? Let's just look at one of these. You have a problem, F1, that's Appendix F in the back of your book. This is one problem that you have there. So let's just see if you can get the general understanding of what you would do in this situation. The problem says, the future value of $30,000 invested at 8% for 10 years. I just want to know logically, what should your answer be? Logically. I'm not asking you to use a table or anything. Just logically. What should your answer be? This is 100%. You will all get to leave immediately. I'm so confident you can. What's that? I keep my word. Does not look like you will be leaving immediately. Boo, boo, boo. All right, take a guess if you don't know. The future value of $30,000 invested at 8% for 10 years. There is no D, so please don't select D. If it's saying the future value, what is that asking you for? What is the future value of 30,000? So the 30,000 is what you have today. It's literally asking you to find the future value. So it has to be something greater. Practice with those, and I'll see you guys on Tuesday. Thank you. We'll get 100, I'm sure.